Welcome everyone to this Investing Mentorships presentation of building a portfolio, and today we're going to focus on indexing, ETFs, and stocks. And you can build a portfolio with the equity mix. We've already talked about fixed income. You can kind of combine those. There are ways to go direct to buy treasuries. So if you're unfamiliar with bonds and fixed income, please watch our bonds video, our fixed income video. Today we're going to focus a little bit more on building the stock side of it and determining how much of a portfolio should be in each thing. What's important is that you stick to the plan, that you really think through the process, what's the plan you want to have in place, and then you stick with that plan. The worst thing you can do is be constantly trying to change and making massive sweeping changes based on chasing what happened yesterday and prior performance. So people really get out of whack because they think, well, my portfolio is not doing as good as something that's being reported on television. So as soon as they shift to that mode, well, there's what have probably started to outperform. There is some mean reversion, and the reality is that nobody can predict exactly what the perfect portfolio is going to be over the next 20 or 30 years. The idea is, where are you at in your life cycle? How many years are you likely to live? What is the best plan in place to really sustain solid income and wealth over that period of time? Don't swing for the fences with everything you're doing. Think about constructing a portfolio that can build wealth over time and sustain you through retirement and so forth. So that's the goal, that's the objective. Obviously, if you're a little older, if you're 80 years old, your goals are going to be a little different than if you're 40 years old, and that's just the nature of investing. Well, if you're 80 and you don't need the income, you might still invest in stocks because you think, well, I'm going to invest in stocks, I'm going to pass this down to my children and my grandchildren, and so you might have a different allocation mix. Understand, we don't know your personal situation. We don't know your real estate holdings and all of these other things. So it's very important that we start there and we talk about the fact that there is risk in investing. We're not giving personalized advice. We're going to talk about some ideas for how one would manage a portfolio, how one would reallocate the capital over time, and do things that investment professionals are doing, but frankly save you a lot of money by not having to pay them to do it. So there's huge benefit to that. When you pay in a portfolio manager 1% or 2% annually, and all they can do is underperform the market, well, thanks, but no thanks. I can do that on my own. Thank you very much. Or I could probably do better by doing the things we're going to talk about today, because this is going to tap into the markets. This is going to get you market average returns, and most in large money mutual fund managers underperform that, and then they charge you fees. They definitely underperform by the time they charge you their fees. So there's a better way, and I think we'll show you how to do that as we talk about this. So the first idea is, how do I get invested in stocks? And there are a few different major categories. Within the US, they break it up into large cap, mid cap, and small cap. And there are a number of different ways to invest in large caps, for example. One of the most popular is SPY. That's the S&P 500. It's an ETF that tracks all 500 companies. So with the purchase of SPY shares, you're literally owning and purchasing all 500 companies at once. IVV is the exact same thing. The only difference is it's made by a different company. But these will track almost identical in every way. They're basically, for all intents and purposes, the exact same thing. So if SPY is up for the year 5.9%, IVV is going to be up either 5.8, 5.9, or 6% or whatever. It's going to be right around that same number with maybe just the slightest of difference. Same thing with mid caps. You can access the mid cap market. There's multiple ETFs. I'm just listing a couple. Small caps, there's a couple of different ways. But again, they're basically the same thing for the most part. Many of these are. Now, sometimes you'll get one that's a little more specific. Like you could have large cap, but then it could just be growth. So instead of being a blend of the S&P 500, it might be a specialty ETF. It might be focused on dividends only, or whatever. There are specialty ETFs, but for the most part, if it's just US large cap, well, it's going to If it's tracking the S&P 500, it's going to perform like all the other S&P 500 products in all likelihood. If you want to invest in the international markets, there are two major ways to do that. You can buy developed international, or you can buy the emerging markets. There are even smaller markets, what they call the frontier markets. And if you wanted the frontier markets, a simple example would be FM. To get you access to the frontier markets. That would be even smaller countries and economies. The smaller you go, the more risk and reward you kind of take on. So developed international are the big international areas around the globe. That's going to get you access to Japan and Europe. And these are countries and economies that have been around for a very long time, proven track records, huge corporations, and so forth. If you invest in the emerging markets, a little more risk because they are emerging markets, but there's growth opportunity there. So this was the famous saying, the BRIC, B-R-I-C, right? Brazil, Russia, India, China. Those are examples of the emerging markets. Now, they're growing, but and they might have more people. When you look at the quantity of people in India or China, those are major, huge growth opportunities and developing economies. But that's what they are. They're emerging markets. They haven't been stable, good, built, strong companies for the long haul. These are countries that are trying to turn into that over the past few decades. So emerging markets come with greater risk and reward, and then again, frontier markets would even be higher risk. But these are really the major markets that you can tap into. You can invest in the US, certainly if you're a US investor, or you can invest internationally, and you could even be specific international. You could go find an ETF that just tracks Canada or just tracks Japan. So you can be very specific with your investments, but again, what's important is the idea of consistency. Don't make huge swings and be constantly changing. If you're always chasing the last trend, you're probably going to consistently underperform and create some problems for yourself. Now, there are ways to do this for free. You can invest in index funds for free. You can invest in a lot of ETFs for free, meaning there's no commission cost to buy and sell these shares. For example, at Fidelity, they have some iShares ETF that they offer free of commission. Ameritrade has their list. Schwab has their list. You can invest in these ETFs, and every time you buy them, you don't pay any trading commission. So you'll notice if we go into domestic equity, that's U.S. equity. You can go blend, which is a mixture. You can go just value, or you can go growth. What's the difference between value and growth? Well, value are kind of the bigger companies, bigger dividend yields, that sort of thing, whereas growth are not as well established but have higher growth rates. The blend is just a combination. It's just the mix. And here's your basic S&P 500. This will tap into the majority of things that are reported. This is considered the market. So when you talk about the stock market, when somebody refers to what did the stock market do today, they're typically referring to the S&P 500. When they talk about how did I perform versus the market, they're comparing their performance to the S&P 500. So that will get you access. If you just bought symbol IVV, the S&P 500 ETF, or bought shares of SPY, the reason I wouldn't buy SPY is you'd pay a trading commission. If you buy IVV and you have a Fidelity account, it's completely free. Or you can invest in the S&P 500 through Vanguard index funds, completely free. Again, that's an important concept. Cut down on your costs, trade, invest in these things for free. Now, if you do that, you're really getting access to every market, because S&P 500 companies don't generate all their profits inside of the US. These are multinational corporations. McDonald's sells hamburgers all around the world. I traveled to China fairly recently, and there was a McDonald's there. Now, it didn't taste the same. They didn't make the Big Mac and the fries and everything the exact same, but if you go some places, it'll taste the exact same as well. But McDonald's and Nike and these corporations are multinational. They're selling all around the world. So some people say, and figure if I'm invested in the S&P 500, I'm tapping into all of these major markets. I don't even need to go further than that. And that is a diversified blend. You'd get a huge diversification. You're pretty much diversified across the marketplace. You don't need to diversify more than that. So some people say, well, could I just buy the S&P 500? And most would argue, yes, you can get away with that. Now, if you want to be more specific and dive down, maybe you want to add some small caps to the mix. So I'd buy IJR. Maybe I want some mid caps. What's the difference in capitalization? Cap is how large you are. So large caps would be, in many cases 20 billion, 30 billion or larger in market capitalization. Mid caps might be, anywhere from 2 billion to 10 billion. Small caps could be $100 million companies up to 1 or 2 billion in their market capitalization. When you go smaller, there's considered more risk and more reward to it. But again, some diversification. So some say, well, I'd like 50% in this and 10% in that and 10% in that or whatever. You could get very specific where you're a big dividend investor. So maybe 10% of your funds just go to that. Or you say, I like dividend growth. So I'm going to focus on that versus just dividends. I want companies that are raising their dividend. And these symbols you can trade through Fidelity. You can invest in them for free. Any of these symbols on their list. And I just pulled this from their list. So if I bought one share of DGRO, I would own all of the stocks in that basket with one share purchase, and I would pay no commission whatsoever. Now I'm the proud owner of that. Now, one share might not be a whole lot of ownership. If I bought 100 shares, I bought 1,000 shares, what have you, over time you could build it up. So as you get money, you can diversify and you can do it for free. So say I deposit $500 at my Fidelity account every month. Well, I could buy, hypothetically, I could buy $300 worth of this with my 500. I could buy maybe, $100 of this and $100 of that. And every once in a while I put in an extra 50 and I add a share or two of my dividend growth. That would be perfectly reasonable. And I'm not paying any trading commission on any of these. I might buy one share of this, 2 shares of this, 1 share of that, and 1 share of this. And then the next month I do the same thing, and I'm building a portfolio, I'm building growth, and I'm doing it in a very cost-effective way. This no commission cost is important, in my opinion. What if we wanted some international exposure, though? Well, you can do that. Remember, I talked about 2 major markets. The 2 major markets are core domestic or developed markets and the core emerging markets. These are the 2 major marketplaces. If you buy IEFA, it's commission free, and that's going to get you access to European companies, Japanese companies, the developed markets internationally. If you buy IEMG, you're not going to pay any commission with Fidelity, and you would be tapping into Chinese corporations, Brazilian, Russian, Indian, and so forth. If you wanted to branch out and get more specific, you can do that. You could say, well, I want the total international stock market. I want it diversified. Or I want some of these frontier markets that we talked about. I just want Latin America. I want India specific, INDY. You can construct your portfolio how you feel it's best constructed. Some people feel like the emerging markets specifically are a little high risk. Maybe China cooks the books, this and that. Well, if you're worried about that, a lot of people trust dividends more because these are actual payouts that companies make, and while not perfect, usually corporations will not be paying out large amounts of dividends and maybe be as fraudulent or in need of capital and that sort of thing. So some people argue that there's a little bit more safety in the emerging market dividend ETF. Again, there's different philosophies. Only time will tell which one would have been perfect, but you can look at those And the idea would be to construct a portfolio such that you have the right fix. Take your time, think about what percentage you want in each of these, set a plan, and then you can go from there. Well, next we have fixed income. Maybe we want some bond exposure. You can get corporate bonds, big basket of them. You can get high yield. These are called junk bonds. You could get investment grade. These are great companies, highest rated out there. You could get government bond ETFs. Now remember, they're buying and selling the bonds for you. You're just investing in it. You could buy TIPS if you're worried about inflation. These are treasury inflation protected securities. So if you thought inflation was going to be an issue, you can buy the TIP ETF and so forth. There are municipal bond ETFs, there are international bond ETFs. It gives you access to the fixed income market, and again, it's commission free. That's an important aspect. And then finally, commodities. There aren't a lot of choices there. You can buy gold miners or silver miners. If you did, it should be a very, very small portion of your portfolio, in my opinion. Maybe you diversify a little bit into gold itself, 2% of your portfolio, 5%, but not some crazy number. And gold and silver miners, same thing. If you're going to get invested in that sort of area, it's probably going to be a very, very small portion of an entire portfolio. But now you've got some ideas of how you can do that, and I'm just showing one example. You could go to Vanguard and do the exact same thing. You could build Vanguard index funds where you buy the S&P domestic, you buy some international index funds, you buy some bond index funds, and you diversify the same way. It would have worked much the exact same way we're talking about here. Just a different approach to it. So what would be a popular mix? Well, one of the most popular mixes of bonds and stocks is a 60-40 portfolio. This is one that's often talked about, and we're not advocating for anything. We're just saying, here's an example. Well, somebody might say, I want 60% of my investments in stocks and 40% in bonds. There are even philosophies that it would kind of change as you get older. So maybe as you're 80 years old, it would match your age. Now you'd have 80% of your money in bonds and only 20% in stocks, right? Because you're getting more and more conservative. So more would go into bonds the older you get. I'm more inclined to invest more in stocks than in bonds. So 60-40 even sounds low to me. That's my approach to the markets today. Now that's subject to change over time. Certainly if bonds yielded more than the 2, 3, and 4% and those types of numbers you're seeing today, then that could be attractive. But in a 60-40 portfolio, what might be an example? Well, someone might say, I want 35% of my money in the S&P 500. That's large cap. That's going to get me access to Google, IBM, Apple, all these big corporations, Johnson & Johnson, ExxonMobil. It's diversified across a variety of sectors. You're getting energy and financials and industrials and telecom and so forth. So a big mix of stocks. You could invest 10% of your capital in small caps, 10% in developed international, and 5% in emerging markets. You add that up, that's 60%. 40% in bonds, you could do 20% in corporate bonds, 10% in short-term treasuries, and 10% in medium duration 7 to 10 year treasuries. You would simply, in this hypothetical example, for every $1,000 you invest, what's the makeup? Well, 350 of it goes here, 100 of it goes here, and so on, because this is your mix, right? So if you put in, for every $1,000 you put in, you would be putting in 350 in IVV, 100 into IJR, 100 into IEFA, $50 into IEMG, the emerging markets, and then another 200 would go here, 100 and 100. And you add it up, and there's your $1,000 split across each of these asset classes in the construction that you want. Now you have all of your $1,000 invested at the percentages you wanted, right? So that's how the capital would go into each of them. Now, an idea that traders, investors have that I think is wise with kind of a stagnant portfolio, and this is not talking about trading. Right now we're talking about just diversified investing and an idea of how an investor could diversify some of their capital and invest it. Make no mistake, I'm a trader as well as an investor. So with some of my money, I invested in kind of these forms, and in some of my money, I actively trade it. And I believe in the markets from both standpoints. A lot of investors rip on traders, and a lot of traders rip on investors, and I think the truth is in the middle. I think there's money to be made in real estate, for example. You don't have to be a house flipper, and you don't have to own real estate long term. There's probably money to be made in both, right? And it's the same with the financial markets. There's money to be made in a lot of ways. So every 6 months, what would we do? Well, let's say that the percentages changed. Remember, we wanted 35% in IVV. It's grown to 38. That means this has appreciated in value. Small caps have gone up from 10 to 11. Developed international has gone from 10 to 12. Emerging markets have gone from 5 to 7. So it's quite clear that our stock portion has gone higher in value. Well, now corporate bonds only make up 16%. Treasury bonds 8 and 8. This was supposed to be 20, so it's gone down. This was supposed to be 10, it's gone down. This was supposed to be 10, it's gone down. What would we do? Well, we'd go sell a few shares of IVV, a few shares of IJR, a few shares of this, and a few shares of that, and that would raise capital, which we would then reallocate into bonds, and we'd buy a little of this, and a little of this, and a little of this until we had our percentages back to where we wanted them to be. Now, it's ideal that you are in a non-taxable account. So this would work great in an IRA. If you're in a taxable account, there would be a tax situation to this. So if you're in a taxable account, you'd probably want to go over a year. Over 1 year before you reallocate, and the reason for that would be that you would be taxed less. In other words, after a full year and you sell a gain, you're taxed at a lower rate because you held it for a year. Your capital gain is lower. So reallocations would happen once every year, and you'd make sure you pass that 1 year mark before you reallocated. Or finally, the last approach, which I personally adhere to, is when new money comes in, you simply even it out. If these have grown, when I put in the next amount of money, I'd be buying here because this needs to be bumped up. If, the next time I add money, this still needs to be bumped up, I'd buy a little more of this. So you can keep your allocations the same also by simply buying more over time and kind of evening those numbers out. There's a number of different ways to do it, but if you just as you put more money in over time, you can simply buy into and keep those percentages roughly the same. They don't need to be exact. Just because you want it IVV to be at 35% and it's currently at 38, that's not going to be the end of the world, and quite frankly, it's just as likely to help you as hurt you in the short term. So anyway, make a long story short, you simply don't want to get those percentages completely out of whack. If you never reallocate, then this could become 65%, and all of a sudden that's because the market's been on a huge tear up, and then the market comes crumbling back down, and by not reallocating, you never sold at the top and bought the weaker things at the bottom, and so you experience all of that downturn. Whereas if you reallocate, the idea is that you'll smooth out the returns. This downturn might still hurt you, but your overall portfolio would grow like this, and then the downturn would be more shallow and it would hit a new high more quickly, and that sort of idea. So by reallocating, you create less risk to the boom and bust cycles. Warren Buffett, one of the most famous investor of all times, argued, and he said in his will for his wife, just do a 90-10 portfolio mix. Put 90% of your stocks in the S&P 500, put 10% in bonds, and don't worry about it. Now, he's about as smart a guy as out there. So he says he would feel much better about 90% in stocks and 10% in bonds. Some professionals, I'm sure, have a big problem with that. Well, don't forget that these pay income as a general rule. The S&P 500 currently is yielding 2% annually. So you're getting income from stocks. If bonds aren't paying much, which they're not right now, you might be collecting, 3% or 4% from your bonds. It's not a whole lot more than stocks. So the question is, how much deterioration in stocks? Well, stocks could be cut in half. So this could be, you just have to be aware that having 90% of your money in stocks, the volatility has a tendency to be higher. But he argues for the 90-10. Put 5% in corporate, 5% in treasury bonds, 90% in the S&P 500. Don't worry about international markets. This was his kind of advice for how people should simplify their lives and just have a diversified portfolio. We kind of adhere to that mix, but we mix it up a little bit in that here's kind of the investing mentorships mix as an example. 90-10 right now works for us. That would change over time, no doubt. But 90% in stocks could be the majority of it in IVV or the S&P 500 equivalent, wherever your money's at. They probably have an S&P 500 product, and you should be investing in it for free, or you need to consider moving somewhere else where you can get access to that for free. 15% in small caps, 15% in developed international, 15% in emerging markets. There's your 90%. 5% in corporate bonds, 5% in short-term treasuries. Some sort of mix like that makes reasonable sense. And again, that's very aggressive. Anytime you're talking 90-10, that's very aggressive on the meter of how much your capital is in stocks. If you felt like the markets were highly vulnerable to a huge downturn, and sometimes people fear, there are perma bears out there that are constantly calling for a crash. Eventually, the markets will crash, but in theory, you should be buying more into that and taking advantage of it, assuming if you're the end of the world guy, it's probably not going to matter if the market crashes and everything goes to zero, because your US dollars wouldn't be worth anything anyway, and all chaos ensues and so forth. So I don't plan for the end of the world. I don't plan for everything going to zero. Understand, some people think that's a real possibility. It's kind of ridiculous. We're talking about 55% of our money being in the S&P 500. Do you really think that Apple, Google, IBM, Johnson & Johnson, Procter & Gamble, Pfizer, Clorox, all these companies are going to zero? That we will have no need to buy household products and to buy homes and cars and to go to work and so forth. I mean, that's the only way these go to zero, right? Is kind of the end of the world scenario where the only thing that's worth anything is food and water and guns and ammo. If that's the case, if you really thought that was the case, you wouldn't invest in any stocks ever. So just understand we're talking about a portfolio mix that is highly diversified, that is on the safer end of the spectrum, but there's still volatility, and certainly stocks can get cut in half. They could go down 50 or 60%. You have to be aware of that type of volatility that can happen over time. Now, find commission-free areas. Watch our video, Trading for Free, with more questions about this. I just pulled a snapshot from Fidelity. If I wanted to invest in the emerging markets, I could buy IEMG, 100 shares or whatever hypothetically, and it would have no trading commission associated with it. I also invest through Vanguard, through index funds. It gets you the same access. They're Admiral shares. If you own at least $10,000 or more, you can get the Admiral shares, which have the lowest expense ratios in the business. So you don't pay any trading commissions or anything like that with ETFs and index funds, but you do pay an annual expense ratio, which have gone down to almost insignificant numbers. For example, this is a screenshot of my account. I own the total stock market index Admiral shares. This is basically big, large cap blend. I own a lot of the biggest companies and so forth. I have $114,261.76 right now in that. Well, at an expense ratio of 0.04, understand I'm paying about $4 annually for every $10,000 I own. Since I own about 114, I'm paying about $4 times 11. So I'm paying about $44 per year to own $114,000 worth of this index fund. $44 per year is very, very insignificant. It's not even 1/10 of 1%. It's 0.04%. To put that into perspective, this is paying me a dividend yield of over 2% annually. So at 2% on 114, that's over 2 grand, 2,100 whatever dollars. So if I'm bringing in $2,000 of income just in dividends, and I own all the upside in the market, and of course I have the downside as well, and I'm paying $44 annually in expenses, that's pretty insignificant. Now, if I bought a mutual fund, they'd probably underperform whatever this is doing. And for the joy of underperforming, they'd probably charge me 1 or 2%. So if my 114,000, I'd have to pay them about 1,000 or 2,000 bucks annually just to underperform the market. So what we're talking about is diversifying your funds, figuring out your portfolio mix, but doing it in a commission-free and low-cost environment. Build out your portfolio. Really think about what percentage. Make a little pie chart. Think about what percentage you want in what, right? Break it up like a pie, and that's an ugly looking pizza. But maybe you want the majority of it in the S&P 500, and you could use IVV with Fidelity, or with, you could buy things like VTSAX with Vanguard for the Admiral shares, or whatever. You want the majority of your funds there. You want some emerging markets. You want some developed international. You want some bonds. Figure out your mix and work to achieve your goals. That's good long-term investing. And then keep your investments and your trades separate. Trading and investing are two different mindsets. Trading, we don't average losers. Losers average losers. As a trader, you don't try to get back to break even in a bad trade. No, you pull the ripcord and you get out of there and you take small losses. As an investor, I'm looking for chaos to buy into, and I don't care if it goes against me for a few more days. I'm trying to get a great buying opportunity into markets that I want to own for the long term at great prices. So it's a very different mindset, whereas a trader is worried about the next few days, and they have very specific risk and reward and parameters around their trade for a few days or a couple of weeks. That's our active trading. Long-term investing is a very different concept. You will use weakness to your advantage. You will build up your portfolio, and over time, you'll collect dividends. You'll reinvest them. It's a different mindset, and that's why at Investing Mentorships, we have the two programs different, right? Different logins, different systems. Value investing and active trading are two different concepts, two different mindsets. They're both very, very effective for making money. So you've learned some good things here. Go and put it to use. Talk about it, work on it, let us know with questions. Thanks for being here. We'll see you next time. Goodbye, everyone.